This is Alternative Angles, the Fidelity podcast where we hear from investors about complex strategies outside the realm of conventional stocks and bonds. I'm Steve Rosen, and I'm your host. Greek mythology tells the story of Theseus, who after slaying the Minotaur, returned to Athens on a ship that was kept in the harbor to commemorate his heroic feats. Its preservation over centuries led Athenians to swap out its wooden planks, and philosophers to ask whether an object, after having all its components replaced, remains the same. For investors in CLOs, it's not just a thought experiment. Rather, it's central to their due diligence process. And that's because a CLO is not a static vehicle. The active management of the collateral pool means the planks of the ship change due to payoffs, defaults, upgrades, downgrades, and trading by the manager. In fact, over the life of a CLO, almost all the original underlying portfolio is replaced, which begs the question, does the primary driver of CLO tranche performance lie in the static, durable structure of the vehicle or in the dynamic, evolving collateral pool? For those investing at the top of the capital stack, the answer veers to structure. Holders of AAA tranches anchor to the resilience of the indenture, things like credit enhancement, coverage tests, and cash flow waterfall, to insulate them from collateral volatility. They are protected by the design of the ship's hull. But for mezzanine tranche investors, the focus shifts. Structural protection is less robust, making the outcome more dependent on the underlying assets and the CLO manager's skill. In essence, mezz tranche investors must iteratively underwrite the planks and the carpenter as much as assess the design of the vessel. To help us break down the interplay between static structure and dynamic collateral, I'm joined by Dave DeBiase, manager of Fidelity's FAAA ETF, and Michelle Liu, manager of Fidelity's FCLO ETF. Combined, Michelle and Dave have 50 years of experience in structured product. They possess a deep understanding of relative value and risk management, and I'm looking forward to hearing how they approach investing in CLO tranches. Michelle, Dave, welcome to Alternative Angles.
Hi, Steve. Great to be here.
Thanks for the invite, Steve. It's great to be here.
Sure, glad to have you guys. Now, to kick us off, I want to hear about your careers and how they led to your current role at Fidelity. So first, Michelle, give us a synopsis of your working life and times.
Great. So I started in the structured product banking group at Bear Stearns in 2005. After a short stint there, I spent most of my sell-side career at Bank of America in the structured securities group. So I was pretty much in the eye of the storm during the GFC, structuring a lot of things on the way in, and then restructuring quite a few of those same things on the way out. Those were very stressful, but also eye-opening years. I've questioned my career choice, but what kept me in it was that I really enjoyed cutting through the complexity, breaking structures down into basic elements of risks, returns, businesses, and human factors such as incentives and behaviors. So by 2012, liquidity was coming back and asset managers were starting to invest in distressed structured products. That led me to Guggenheim in early 2013 to invest in CLOs, and a few years later to KKR, where I helped launch and grew its structured credit investing strategy to a multi-billion-dollar business. I joined Fidelity in September 2023, mainly because I saw the opportunity around the democratization of alternatives. You know, Fidelity, as one of the world's largest asset managers, is in a very unique position to bring liquid and less liquid alternatives to investors in a thoughtful way. And I wanted to be part of that change, especially as the structured credit and CLOs increasingly move from institutional-only product into wrappers like ETFs and the mutual funds.
Great. And turning to you, Dave, I know we've known each other for ever and a day, but others aren't as familiar. So how about if you share a brief background on your career with us?
Sure. Happy to. Yeah, quickly on my background, I started in the industry in the late 90s as an analyst in securitized markets. I did that for about 8 years at a at a different money manager. I joined Fidelity in 2006, just in time for the financial crisis, as a securitized trader. During that period, I traded mostly subprime mortgages and other non-agency mortgages during the financial crisis. And then I moved into trading mortgage CMOs and mortgage derivatives for a few years, and then traded corporates for a couple of years after that. For the past 9 years, I've been a portfolio manager in the investment grade bond division here at Fidelity. I'm part of a team, we call it the low duration bond team. We manage about $80 billion. It's mostly short duration, diversified portfolios. So that's the quick background for me.
Nice. So before we dive into today's topic, let's take a short step back to talk about the underlying collateral for a CLO, which are broadly syndicated loans, also known as leverage loans or term loans. So starting with you, Dave, please set a foundation for us with a table setter on broadly syndicated loans.
Sure. Yeah, let me just reiterate that broadly syndicated loans, leverage loans, basically mean, the same thing in the market terminology. They're loans to below investment grade companies that are typically rated double B or single B. They sit at the top of a borrower's capital structure, and they're also secured by its assets. So a senior debt, they historically have a better recovery rates than unsecured debt. The loans are generally arranged by large investment banks and broadly syndicated to institutional investors such as loan funds and CLOs. CLOs are quite important in this market. They're the largest buyers of broadly syndicated loans. They probably buy about 2/3 of the broadly syndicated loan market. And I think the last thing to mention as we're talking about leverage loans is there are differences between leverage loans and private credit. Private credit is generally smaller loans to smaller companies. They're usually bilateral, which means it's usually one borrower, one lender. Occasionally, you'll see a couple lenders in one borrower, but generally it's pretty limited. Because they're bilateral, they'll have less liquidity, less price transparency. They don't really trade very often because it's not the vehicle they're designed for. They often have more customization in their structure. It's usually the company is looking for some kind of customized structure because of some, situation with the business. And so broadly syndicated loans are in general larger, more liquid, have more standard structure than private credit.
Right. Now, turning to you, Michelle, why don't you continue on with what Dave was talking about in terms of a description of leverage loans? Give us a little bit of a description of the coupon structure of them. And then if you could you pivot to the historical credit performance of the leverage loan market?
Sure. So loans are typically a floating rate instrument that pay a spread over short-term rate, which is SOFR, which makes them especially attractive in a rising rate environment. Most also actually have a SOFR floor, which is not talked about broadly. The SOFR floor is around 75 to 100 basis points, which helps preserve a minimum yield if risk-free rates fall too low. Now, to credit performance, I would break that down into two important aspects: defaults and recovery. On defaults, the long-term volume-weighted average default rate, according to S&P, since 1998 is about 2.75%, which is actually quite similar to high-yield bonds at roughly 2.8%. But like any credit asset, the average masks a lot of cyclicality. Defaults peaked at about 12% in 2009, hit roughly 7% during the dot-com downturn, and around 5% during COVID. In more borrower-friendly years, such as 2006 or 2021, defaults were below 1%. Today, the trailing 12-month default rate is around 1.5%, or closer to 3% if you include distressed exchanges. Now on to recoveries. Loans have historically outperformed high-yield bonds because they are usually senior in the capital structure. So they rank ahead of bonds and equity in the bankruptcy. Post-GFC, average recovery have been around 55% for loans, versus about 38% for high yield bonds. That said, recoveries have drifted lower in recent years as covenant light loans have become the norm. And that is an important risk factor to keep in mind when investing in CLOs and loans.
Okay. Now, moving from the underlying loans to today's topic, CLOs, Dave, how about if you give us a description of a collateralized loan obligation?
Sure. Happy to do that, Steve. A CLO is essentially a temporary company. It's often it's a special purpose vehicle. It's an entity built just for that purpose, to buy a pool of diversified leverage loans that are then funded by different tranches of bonds sold to investors. So securitization through the CLO structure, in my mind, basically connects large institutional capital to the high yield loan market through tranches of varying risk. So instead of just a pool of single B rated loans, now investors have options to buy AAA rated bonds all the way down to equity, depending on their risk tolerance. And another key feature, as Michelle mentioned, the underlying loans are floating rate and the CLO bonds are also floating rate, which eliminates any kind of interest rate risk in the CLO tranches. The CLO is issued by a manager who tries to maximize return of the underlying collateral while minimizing defaults. That could be a money manager like Fidelity, an insurance company, a private credit fund, basically any entity that often has years of experience investing in leveraged loans. The tranches basically reallocate risk. So they create some bonds that are delevered, like the senior AAA rated bonds, and then some bonds are leveraged to the pool of loans like the equity. The AAA bonds are usually the top 60 to 65% of the debt stack. The middle of the stack, usually called the mezzanine bonds, because they're in the middle, are the next 20 to 25%, which are usually rated between AA to BB. And then the bottom 10% or so is the equity that is not rated. The cash flow from the loans, the interest and the principal, is distributed in what is called a waterfall as it rolls down from the senior AAA tranche first, and then into the lower rated bonds and ultimately to the equity. If loans default and there are losses in the underlying collateral, then those are allocated from the bottom up. So it's the opposite of how the principal and interest is distributed. The losses go from the bottom up. It goes first to the equity, then to the BB, BBB, et cetera, from the bottom up. Maybe an example of the reallocation of risk might be helpful. If there is 1 point of loss in the underlying pool, there's defaults and then recoveries, and there's a point of loss, and you own that loan pool overall, then you would lose 1% of your principal. It's pretty straightforward concept if you just own that pool of loans. But for example, if you own the bottom 10% of a structure with that same loan pool and say 1% loss, now you just lost 1 point of your 10 and you lost 10% of your principal. Conversely, the AAA doesn't take any write down until losses get above 35% or so. So that is like the basic way the risk is reallocated by tranching, by creating these different tranches where some of the losses are concentrated and some of the losses are protected by the credit enhancement and structure of the vehicle. And the last point I'll mention is there are also additional structural features in the CLOs, such as industry and issuer diversification tests, over-collateralization and interest coverage tests that divert cash flows, CCC ratings tests and limitations, and several other that protect the bonds and divert cash flow in the structure that actually adds additional enhancement for the senior bonds.
Okay, nice description. Michelle, moving back to you from the point of view of an allocator, be it an institutional investor or a wealth manager who's got numerous choices, where do CLOs fit and what are the trade-offs to consider in making an allocation to them versus, say, the other fixed income options that are probably more straightforward or at least structurally so?
Sure. For a capital allocator, whether institutional or wealth, I think CLOs fit very naturally in an income-oriented portfolio. We're no longer in the world of QE and zero rates. In today's market, where rate volatility remains elevated and the inflation has been stickier than many expected, I think floating rate carry assets deserve a real place in fixed income allocations. And CLOs in many cases offer more carry than similarly rated traditional fixed income products. I also think CLOs fit well in a multi-strategy credit portfolio, which has been pretty popular among institutional investors. In particular, lower mezzanine CLO tranches can offer a compelling combination of structural protection and more carry than loans and high-yield bonds. They can also be a useful way for investors to express a macro view on the broader credit cycle, including defaults, recovery, and the spread direction. In terms of trade-offs, I think lower mezz CLO tranches can be more price volatile, especially during risk-off periods. CLOs also generally have relatively limited call protection, so reinvestment risk can be fairly high. And later in the credit cycle, when spreads are tight and the deals are refinancing, I think that is exactly when investors need to be more careful about putting money back to work in the same assets at less attractive levels.
Okay. Now, you're investing in the same loan pools, but in different risk tranches of the capital structure. So starting with you, Dave, what do you pay very close attention to in the AAA strategy that might be of less concern, say, to an investor in mezz tranches?
Sure. Yeah, as a senior investor, I would say the thing that I think is the most important is the legal structure of the deal. And what I mean by that is there's rules within these deals that I think are important. Concentration limits, over-collateralization rules that are being followed, issuer limits, industry concentrations, all those kind of things, and obviously the credit enhancement of the deal. We're really worried about systemic risk because we have 35 to 40% of the structure below us. I explained that a little bit earlier, where the losses are put into the deal from the bottom up. And if a deal is heavily exposed to one sector like energy or software, that's what I worry about as a problem. Idiosyncratic risk is important, but I think it's less important to the AAA investor because one company defaulting is not really going to hurt the AAAs when they have 35% enhancement. But as I kind of explained earlier, if you're in the mezz class or even at the equity, that's going to really matter to you. So I think that's really one of the major issues we think about is the structure. Prepayment risk or reinvestment risk is also another thing we think about quite a bit. There's reinvestment periods in these deals where the manager recycles loans that have paid off. But once that ends, you could be exposed to pay downs as the first paid tranche in the AAA. So you get pay downs and also you could have the bonds refinanced away from you. So if I have a higher than market coupon, that creates reinvestment risk for us. So that's something we think about quite a bit as well. And I think the last thing to mention probably as a AAA investor that we think about a lot is liquidity. We think about that quite a bit. And so liquidity is often determined by manager and deal performance. So if either a manager or a specific bond is underperforming the market, it'll become less liquid. So ongoing surveillance of the market is really important. So that's something that we spend a lot of time on and something that we think about quite a bit is liquidity of whether it's the manager broadly or the deal specifically.
Okay. And Michelle, let me reorient that question for you. What do you follow carefully and try to predict that matters to a strategy that's more focused on risk?
Sure. So Steve, if I'm investing in a more credit-centric, say triple B or double B CLO tranche portfolio, or tranche backed by the same loan pool in your question, what I'm really trying to underwrite is the forward credit performance of that pool. I'm thinking about which loans are more likely to default, how much loss the portfolio may experience, and what rating migration could look like over the next 12 to 24 months. Then I take those views and layer in the CLO structure to assess how the bond itself is likely to perform. So for a credit-oriented CLO strategy, it really comes down to two things: the health of the underlying portfolio and the strength of the structural cushions protecting the tranche. Those are usually the key drivers of how a BB or a BBB rated CLO will perform or behave, especially in the sense of trading prices in the secondary market. And lastly, I want to mention that I also spend a lot of time analyzing CLO managers and predicting their behaviors, because those portfolios are actively managed and they evolve over time. Manager behavior really matters. Their ability to select the right credits, avoid weaker situations, and trade the portfolio effectively can have a meaningful impact on the performance.
Okay. Now, when I think of each of your strategies and I hear AAA, I think about safety. And when I hear mezzanine, I think about credit risk. But those are, oversimplifications. They're incomplete characterizations of your strategies. So, to turn those generalizations on their respective heads, how about Dave? What are the risks of investing in the more senior CLO tranches? Because there must be some.
Oh, there's definitely risks. Yeah, for sure, Steve. Although I would say when I think about AAA, I do think about safety also, but there are for sure risks. Let me just start by saying I do hear what you're saying and think about the risk quite a bit. I think the principal loss discussion on AAA CLOs is part of the analysis, like we talked about the structure, but I think a little bit more about how these bonds perform in different market environments. I think, the spread is pretty low, relatively speaking, to other tranches in the capital structure. AAAs, ballpark are generally in the 100 to 130 over spread for AAAs. So the level of interest rates, in this case, SOFR, which is what CLOs are benchmarked to, which is the secured overnight funding rate, which is the floating rate part of the coupon, is really important. So that's currently about 75% of the coupon that you get in a AAA CLO. And if short rates decline, that makes these bonds less compelling, I would say. So interest rates are a big thing to think about when you're investing in AAA CLOs. That's probably the first thing and biggest, because it's a big part of that coupon. Prepayment risk or reinvestment risk is another thing to think about. AAA bonds are first to be paid. So if you have an attractive coupon that you own, that bond could be paid down or refinanced away from you. So that's a risk we think about as well in these bonds. And then I would say the other thing is, generally speaking, liquidity is something to think about. Michelle touched on this. Generally, they're pretty liquid, but in moments of market panic, the prices of AAA CLOs can move quite a bit. So that's something to think about when managing position sizes or overall risk position, is that the bonds are very resilient from a credit perspective, like I mentioned, but they do have liquidity issues occasionally. And so you don't want to be selling bonds during a distress period and lock in losses for yourself. So that's another thing I would think about when investing in AAA CLOs.
All right. And Michelle, why don't you give us some perspective on the historical resilience of CLO structures?
Sure. I would just start with this. In periods of market stress, you will see CLO structures bend but don't break. That to me is the key historical takeaway. The structure has been tested, as Dave alluded to, through multiple credit cycles, and importantly, it has generally done what it's designed to do. So first, the subordination matters. The equity sits at the bottom of the stack and is there to absorb losses before they even reach the rated debt tranches. Second, when a deal starts to come under pressure, the structure has mechanisms that can trap equity cash flows and redirect that value to protect the debt, whether that means paying down senior notes or buying more collateral. And third, CLO managers are usually given both time and flexibility to actively manage through stress. That can mean selling tail risk credits, buying loans they believe are oversold relative to fundamentals, or simply holding on to loans, they still expect to pay back at par, regardless of where they happen to be trading in the market. So when people think about CLO stress, it is important to separate price volatility from actual structural impairment. Those are not the same thing. And in CLOs, that distinction really matters. And if you look at the historical numbers, they reinforce that point. According to S&P's tally, over more than 30 years, only 40 out of roughly 3,300 double-B CLO tranches issued have been impaired, and only 9 out of about 4,000 triple-B CLO tranches have been impaired. And no CLO notes originally rated AAA, AA, or single A has defaulted. So yes, CLOs, especially mezz debt, can absolutely be volatile in stress market, but historically the structure has proven to be a lot more resilient than the price action alone may suggest.
Okay. And Michelle, sticking with you, given the risks and the opportunities that you and Dave have just outlined, what are the resources the two of you have here at Fidelity to help you fulfill your mandates?
I will start with the fact that Fidelity's fixed income platform is a real powerhouse. In credit alone, we have roughly 300 analysts covering thousands of businesses every day, which gives us deep bottom-up insight into companies, industries, and the credit trends. Then you add our scale, our vantage points to see capital flows, and our presence across the capital markets. And that gives us a broader and more informed view of the overall market and macro economy. It also matters that we are a CLO manager ourselves. We have dedicated analysts covering the vast majority of the loan market, including all those names underlying each CLO. So we understand the collateral from the inside, not just from the outside. And as one of the largest asset managers in the world, we have broad access to dealers and CLO managers, which helps drive more information flow, enabling better manager selection and better execution.
Okay. Now, Dave, Michelle just mentioned CLO managers. In your view, what characterizes a top-tier CLO manager, and to what degree do you think investing in their deals may result in extra return for your investors?
Yeah, sure. I mean, I think manager selection is critical. It's something that we think about a lot. And the best managers are very good at risk management and credit selection. Those are, I think, the two main things. What do I mean? What do I mean by those two things? Generally, the best managers are better than average avoiding defaults. They minimize selling loans below cost, which can be a problem in a CLO. It locks in losses and reduces the collateralization of the deal. So that's basically the protection. So that's a problem. And they generally have fewer negative rating actions than other managers. So basically they have the resources, the personnel, the infrastructure to pick the best loans. And then when loans are going bad, they're early in risk management. So that's generally the characteristics we look for. A lot of times, if they're very good, they can build par in deals, which means you buy loans at discounts that eventually will fully recover, and then add collateralization to the structure, which is another benefit they can offer if they're very good. The extra return that you mentioned for investors, it depends, and it's generated by which tranche you're in. So the equity returns can vary widely by manager. As we've mentioned there, that's the leverage part of the structure. So they basically get the residual of all the loan cash flows minus all the financing costs of the bonds. So those can vary widely. Mezzanine tranches have, I would say, moderate to high exposure managers. They, obviously the lower rated tranches have more exposure, but as you go more up the capital structure, there's a little less. But a weaker manager might, have deals that are tripping triggers and diverting cash flow more often than other managers, and that's a negative for mezzanine tranches. And then what I would say the AAAs is probably more related to the reputation of the manager, which impacts liquidity and spreads on the senior bonds quite a bit. So the market will differentiate between different managers in their historical track record on how well they trade and where the bonds trade on a spread basis. So I say those are kind of the different areas where the manager can matter.
All right, and Dave, sticking with you, aside from manager quality, what other elements of a CLO can produce alpha for you?
Yeah, good question. I would say the other two things I think about probably away from the manager that has impact on the CLO is probably the deal structure, which I talked a little bit before. That's obviously very critical, particularly for the senior bonds. And then the vintage is also really important besides the manager. Again, it depends on where you are in the capital structure, but CLOs are not static. So if loans can be purchased by the CLO when they are at discounts, for example, sometimes deep discounts, like periods after COVID when loans were, at kind of historically low prices, and the capital structure can be refinanced in later years to lower debt cost, much of that appreciation in the loans will accrue to the equity and other parts of the capital structure. A good vintage, when the arbitrage is attractive and loans are below par, will generally benefit all tranches, but more so for the equity and lower rated tranches. When loan prices are near par and the arbitrage is tight, those vintages can be a little bit disappointing. So we think a lot about the vintage and where loans are being purchased and how tight the arbitrage is. I think another broad way to generate alpha with CLOs is identifying relative value among different fixed income opportunities. CLOs often have additional spread versus similarly rated bonds due to their complexity primarily. And so if you have the resources to analyze the managers, the underlying collateral, and the structure, there is additional yield to be captured within the CLO market at the various rating categories.
Okay. Now, I'm going to jump back to you, Michelle. Dave just mentioned this idea of relative value. And so I'm just curious, are there rules of thumb that tell you when CLO tranches are attractive relative, say, to their own history and versus other choices, be it an investment grade credit, high yield credit, and other structured products?
Yeah, sure, Steve. That's a great question. I do have a few rules of thumb, although in CLOs, I'd call them guidelines, not laws of physics, because the market is constantly evolving. So first, relative to CLO's own history, I usually anchor off the CLO 2.0 era that refers to all the deals issued after the financial crisis since late 2012, early 2013. Very roughly, median spreads have been about 130 to 150 basis points for AAA, around 380 for BBB, and about 675 basis points for BB. So if spreads are meaningfully wider than those levels, and that usually gets my attention. That said, I try not to be too formulaic because this market has evolved. I do think median spreads have come down over time as CLOs have become more mainstream, and some of the post-GFC PTSD in structured credit has faded. As people always say, history rhymes, but it doesn't repeat. As CLO investors, we try to stay flexible and recognize that the market keeps changing. A better rule, in my view, and this is less intuitive, is to look at the spread relationship between BB and single B rated loans. If single B loan spreads look too tight relative to BB loans, CLOs are probably too rich as well, given that CLOs own anywhere between 85 to 90% of the single B loan market, and in some ways are essentially derivatives of that market. Conversely, if single B loan spreads widen relative to BB loans beyond historical averages, CLOs usually cheapen too, which can create compelling entry point, especially in mezzanine CLO tranches. The other lens of relative value is versus similarly rated alternatives, whether that's IG, high yield, or other securitized products. CLO do tend to trade wider, which on the surface looks attractive. But wider spreads do not automatically mean better total return, especially lowering the cap stack. CLOs can be more volatile, and because they are floating rate instrument, the coupon can come down if the Fed cuts rates. So the real question is not just whether CLOs look wide, but whether you are being paid enough for the complexity, the liquidity, the volatility, and where we are in the credit cycle. I think CLOs are part of the broader credit complex. And the one rule of thumb that always holds in my mind is that the pricing of risks and the sentiments swing like a pendulum in credit. So I use that quite a bit in framing relative values at different point of time.
Makes sense. Now let's move to liquidity. Michelle, please describe it broadly for the different segments of the CLO market. And if there's a liquidity pinch point, is it buying or selling?
Sure. I'll start with very high level comments there. Secondary liquidity in CLOs have broadly kept pace with the growth of the market. Average annual secondary trading volumes as a percentage of bonds outstanding is roughly 20% for investment grade CLOs and about 40% for below investment grade CLOs. Those percentages have stayed fairly stable over the years, even as the market has nearly tripled in size over the past decade. So in that sense, I think liquidity has improved meaningfully as market depth has grown. What's driving that improvement is that there are simply more participants across more types of accounts. CLO reporting has also become more standardized and transparent, and the tools and data available to investors are much better and more real time than they used to be. So overall, the market is deeper, broader, and easier to navigate than it was 5 or 10 years ago. That said, in a market that is gapping down, CLOs, as Dave mentioned earlier, especially lower mezzanine tranches, can still see meaningfully wider bid-ask spreads, partly because dealer balance sheet dedicated to CLO trading are generally smaller than they were 5 or 10 years ago. And if there is a pinch point, in my view, or a real pinch point, is a CLO equity. That part of the market has less depth and more information asymmetry. So if you ask whether the liquidity pinch point is the buying side or the selling side, I think it's usually a selling problem. The market tend to feel liquid until everyone wants out at once.
Yes. Now, before we wrap up, we've had a great discussion so far, but we're getting close to time. I want to address economic scenario analysis from a historical perspective. So what happens to CLO tranche credit and price volatility in, say, a mild recession and in a more significant downturn? And Dave, why don't you start, and Michelle, tack on as you see fit.
Sure. Thanks, Steve. I would say in the mild recession category, and we think about AAAs and mezzanine bonds probably differently. AAAs, we've mentioned this a few times, they have 35% or more credit enhancement, can easily absorb an uptick in default. So in a mild recession, if defaults increase a couple percent, that's not a huge concern for AAAs, but you are going to see spread widening. So you're going to see, on the order of 50 to 75, maybe even 100 basis points of widening in the top of the capital structure. So there's definitely some spread volatility there. On mezzanine bonds, I would say there is probably more credit concern in a mild recession. Obviously, they're lower in the capital structure. They have more sensitivity to defaults. So you could potentially see some downgrades, and you will see, again, a lot of price volatility. Prices may drop 2-3% even. So there's quite a bit there. I would say in a severe recession, if you're thinking about the financial crisis or even more recently in March 2020 during COVID, we did see pretty good drawdowns in AAAs of, a couple percent, and triple Bs saw drawdowns even more extreme than that for a short period of time, double-digit percentage drawdowns. But even during the financial crisis, there has never been a AAA CLO default, and mezz defaults, as we mentioned earlier, were pretty minimal, even in distressed periods. So I think the takeaway would be the credit performance is pretty resilient. And I think the greatest risk probably for CLO investors is being forced to sell during those market periods of distress. So, the credit performance has been historically resilient, but there is price volatility. But if you can hold on, I think the credit has been pretty resilient. And the last thing I'll mention is that, to be clear for everyone, the structure is a closed vehicle. So the CLO is never winding down during distress periods. It's not a fund that is getting redeemed and being forced to sell loans. So if you hold the bonds, the structure never changes. And so the bonds often recover because of that. So there's no, there's volatility around CLOs, but I think the credit has been very resilient. So the bonds often recover pretty quickly.
And Michelle, you have anything to add?
I think Dave summarized it really well, but I would just add one thing. I think that the shape of the downturn, I think in the mild downturn, I think pretty much across the CLO debt cap stack, all the tranches will fare okay. But in a more significant, severe downturn, I think the shape of the length of the period of that downturn matters. So if you look at the GFC period, right, this is very much a V-shaped downturn. So it's all these bonds have very big drawdowns, significant drawdowns, but they all bounce back relatively quickly. But in a more protracted downturn, I think that's probably the relatively more dangerous type for the lower mezz tranches. But even having said that, you still need multiple years of consecutive elevated losses on the order of 3 to 5% hitting the underlying loan portfolios to impair a double B tranche. And if you compare that number, with loan market has experienced historically, which is roughly 100 basis points of losses plus minus over 3 decades, and also looking at these CLO portfolios, they actually generally outperform the broad market from a par preservation standpoint. These portfolios, depending on the manager caliber, experience losses anywhere between 0 to 100 basis points. So yeah, just going back to my earlier point, I think the shape of the downturn and the tenor of the downturn matters, but it still would take significantly more stress than what we have experienced historically to even impair the junior debt tranche in CLO structures.
Okay. Well, that's a wrap for my questions. I really appreciate that you guys took the time to sit with me and talk about CLOs. And so thank you.
Thank you, Steve.
Happy to do it, Steve.
This podcast is intended for institutional investor and investment professionals only. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or a solicitation to buy or sell any securities. Views expressed are as of May 2026, based on the information available at that time and may change based on market and other conditions. Unless otherwise noted, the opinions provided are those of the speakers and not necessarily those of Fidelity Investments or its affiliates. Fidelity does not assume any duty to update any of the information. Unless otherwise expressly disclosed to you in writing, the information provided in this material is for educational purposes only. Any viewpoints expressed by Fidelity are not intended to be used as a primary basis for your investment decisions and are based on facts and circumstances at the point in time they are made and are not particular to you. Accordingly, nothing in this material constitutes impartial investment advice or advice in a fiduciary capacity, as defined or under the Employee Retirement Income Security Act of 1974 or the Internal Revenue Code of 1986, both as amended. Fidelity and its representatives may have a conflict of interest in the products or services mentioned in this material because they have a financial interest in the products or services and may receive compensation, directly or indirectly, in connection with the management, distribution, and/or servicing of these products or services, including Fidelity funds, certain third-party funds and products, and certain investment services. Before making any investment decisions, you should take into account all of the particular facts and circumstances of you or your client's individual situation and reach out to an investment professional if applicable. References to specific companies or investment themes are for illustrative purposes only and should not be construed as recommendations or investment advice. Investment decisions should be based on an individual's own goals, time horizon, and tolerance for risk. The securities mentioned are for illustrative purposes only and not necessarily current holdings invested by FMR LLC. References to specific issuers or securities should not be construed as recommendations or investment advice. This piece may contain assumptions that are forward-looking statements, which are based on certain assumptions of future events. Actual events are difficult to predict and may differ from those assumed. There can be no assurance that forward-looking statements will materialize or that actual returns or results will not be materially different from those described here. Alternative investments are investment products other than the traditional investments of stocks, bonds, mutual funds, or ETFs. Examples of alternative investments are limited partnerships, limited liability companies, hedge funds, private equity, private debt, commodities, real estate, and promissory notes. Some of the risks associated with alternative investments are: alternative investments may be relatively illiquid. It may be difficult to determine the current market value of the asset. There may be limited historical risk and return data. A high degree of investment analysis may be required before buying. Costs of purchase and sale may be relatively high. Fidelity AAA CLO ETF invests significantly in collateralized loan obligations, CLOs, which are associated with a number of risks including liquidity, interest rate, credit, event, and call risk, as well as the risk of default of the underlying assets. While the fund invests principally in CLO tranches that are rated AAA, such ratings do not constitute a guarantee of credit quality and may be downgraded. To the extent that the fund invests in CLO tranches rated below AAA, the risks of investing in CLOs will be greater. The CLOs in which the funds invest are managed by investment advisors independent of the advisor and may be subject to conflicts of interests, including managing the assets of other clients or other investment vehicles, or receiving fees that incentivize maximizing the yield and, indirectly, the risk of a CLO. Fidelity CLO ETF invests significantly in collateralized loan obligations, CLOs, which are associated with a number of risks including liquidity, interest rate, credit, event, and call risk, as well as the risk of default of the underlying assets. CLO tranches rated from BBB+ to B- are often subordinate to higher-rated tranches in terms of payment priority. Subordinated, that is mezzanine, CLO tranches are subject to higher credit risk and liquidity risk relative to more senior CLO tranches. The CLOs in which the fund invests are managed by investment advisors independent of the advisor and may be subject to conflicts of interests, including managing the assets of other clients or other investment vehicles, or receiving fees that incentivize maximizing the yield and indirectly the risk of a CLO. Fixed income securities carry interest rate risk. As interest rates rise, bond prices usually fall, and vice versa. This effect is typically more pronounced for longer-term securities. Fixed income securities also carry inflation risk, liquidity risk, call risk, and credit and default risks for both issuers and counterparties. Unlike individual bonds, most bond funds do not have a maturity date, so avoiding losses caused by price volatility by holding them until maturity is not possible. Lower quality bonds can be more volatile and have a greater risk of default than higher quality bonds. Floating rate loans may not be fully collateralized and therefore may decline significantly in value. Foreign markets can be more volatile than the U.S. market due to increased risks of adverse issuer, political, regulatory, market, or economic developments, and can perform differently from the U.S. market. Leverage can increase market exposure, magnify investment risks, and cause losses to be realized more quickly. Unlike certain ETFs, the fund may affect some or all creations and redemptions using cash rather than in-kind securities. As a result, an investment in the fund may be less tax efficient than an investment in an ETF that distributes portfolio securities entirely in kind. The funds may have additional volatility because it can invest a significant portion of assets in securities of a small number of individual issuers. An ETF may trade at a premium or discount to its net asset value, NAV. Stock markets, especially foreign markets, are volatile and can decline significantly in response to adverse issuer, political, regulatory, market, or economic developments. Securities selected using quantitative analysis can perform differently from the market as a whole as a result of the factors used in the analysis, the weight placed on each factor, and changes in the factor's historical trends. Securities lending involves the risk that the borrower may fail to return the securities loaned in a timely manner or at all. If the borrower defaults on its obligation to return the securities loaned because of insolvency or other reasons, a fund could experience delays and costs in recovering the securities loaned or in gaining access to the collateral. S&P rating, a bond rating system provided by Standard & Poor's, S&P, to rate the quality of bonds based on the rating agency's assessment of the quality of the bonds. For example, AAA is best quality, A- is a lower quality. S&P rating, a bond rating system provided by Standard & Poor's, S&P, to rate the quality of bonds based on the rating agency's assessment of the quality of the bonds. For example, AAA is best quality, A- is a lower quality than AAA, etc. A rating of BBB- is the lowest S&P credit rating that is still classified as investment grade. In the S&P rating field on some search results screens for fixed income secondary market offerings, for example, bonds, this field displays the rating, or NR, not rated, if Standard & Poor's Corporation has not rated the security. S&P is a registered service mark of the McGraw-Hill Companies, Inc. Secured Overnight Financing Rate, SOFR. The Secured Overnight Financing Rate, SOFR, is a benchmark that banks use to price short-term interest rates for U.S. dollar-denominated derivatives and loans. Its origins can be traced back to April 2018, when the New York Federal Reserve began publishing the rate as a potential replacement for the London Interbank Offered Rate, LIBOR. SOFR is a broad measure of the cost of borrowing cash overnight collateralized by U.S. Treasury securities in the repurchase agreement, repo, market, and is considered preferable to LIBOR because it is based on data from observable transactions rather than estimated borrowing rates. Each business day, the New York Fed publishes SOFR on its website at approximately 8 a.m. Eastern Time. For more information on SOFR's publication schedule and methodology, see additional information about reference rates administered by the New York Fed. Past performance is no guarantee of future results. Investing involves risk, including risk of loss. Fidelity Investments provides investment products through Fidelity Distributors Company, LLC, clearing, custody, or other brokerage services through National Financial Services, LLC, or Fidelity Brokerage Services, LLC, members NYSE, SIPC, and institutional advisory services through Fidelity Institutional Wealth Advisor, LLC. Before investing in any mutual fund or exchange-traded fund, you should consider its investment objectives, risks, charges, and expenses. Contact Fidelity for a prospectus, an offering circular, or, if available, a summary prospectus containing this information. Read it carefully. Copyright 2026 FMR LLC. All rights reserved. 1260484.1.0